by the way, that's why the central banks have been buying so much gold to recapitalize their balance sheets, because what's going to happen to gold when all this goes off? Straight up, why is Trump saying we're going to revalue the gold but hadn't done it yet? They're waiting on the value to go, and they're going to recapitalize, and it's going to help them address the issues, gold and Bitcoin, address the issues in the sovereign wealth fund with the debt, and allow hopefully some version of the dollar survive in an electronic format. That's something I've been worrying about for 5 or 6 years. It's a complete switch over of a system. And if you're looking at the future through the lens of the past, you're not going to understand or see it. And that's why a lot of people don't understand or see it.
A broad transition is underway across the global financial system as debt saturation, weakening productivity, and rapid technological displacement collide with unprecedented central bank intervention. Major institutions are shifting into gold, not as a speculative trade but as a balance sheet necessity in preparation for profound structural realignment. Physical demand remains firm while futures markets reflect hesitation tied to year-end positioning, policy uncertainty, and growing divergences between deflationary output and inflationary price pressures. At the same time, AI-driven efficiency gains are triggering widespread layoffs, reducing wage flows, tightening consumption, and amplifying currency stress across Europe, Japan, and leveraged U.S. sectors. These pressures point toward a volatile transition phase that aligns with historical debt cycle resets. Robert Kientz, an analyst known for connecting monetary cycles with real asset behavior, highlights how AI adoption, collapsing corporate debt structures, sovereign imbalances, and diverging central bank strategies are converging into a late-stage reset dynamic. His view underscores that gold's strength is not dependent on inflation alone. It rises during both inflationary and deflationary contractions when confidence in currency systems deteriorates. Now, we present the clips from Robert Kientz's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think gold and silver, or gold in particular, are becoming really interesting to the main financial houses. And also, if you look at the COMEX futures positioning, the ones that are holding up the gold end on these futures positions are the other reportables, which are like wealthy family offices, large investors, and then the financial houses. So the big financial houses, like if you're investing your money with Schwab or any of these types of guys, those guys, financial houses, hedge funds, are now investing in gold. And that's holding up the gold market where it is. You still have a lot of massive shorting done by the banks, but I think there's repositioning. And I think what's happening is you've had this huge move into gold, and people are paused right now because, one, it's a derivative trade. It's not a physical trade determining the price, and people got to reposition for the new year. We're coming up on December. Physically, gold demand is at record highs, silver as well, but that's not where the short-term price is. But people are looking at things like the repositioning on a futures market, and they're looking in the meantime about what's going on with the Fed. And the Fed there's this rift in the Fed right now. Half of the governors want to ease. They want to print money, and they want to lower interest rates. The other half of the governors are like, no, let's hold, because what they're looking at is the employment situation is not great. And unfortunately, we did not get the November employment numbers because the government shut down, and therefore the non-farm payrolls was not officially reported. And so there's some uncertainty, even with the Fed, in knowing what those numbers are. Now, jobless claims are pretty even, but when you look at AI is taking away many, many, many jobs, and people are losing their jobs. I'll give you an example. Verizon, my former company, is laying off 13,000 workers, their largest single layoff in history. When I was there, we had 120,000 people. Now they have 100, and they're laying off 13 to go to 87. And their new CEO is taken over for Hans. Hans was a 5G guy. He was a former, I believe it was either Ericsson or one of those European telecom companies who came on, and he was there when I was there. And he led this development of 5G expansion for Verizon, because 5G is going to be their core product, right? And I was doing cybersecurity on the 5G network then, so I was in tune to all that stuff when I was at Verizon. But their new guy is the former CEO of PayPal. So what does that tell us? It's happening. AI is taking jobs. The tech companies are moving to AI and laying off, and then they're bringing on financial types to monetize that existing infrastructure. So the tech companies are monetizing the move into AI now. The problem is you have AI blowing up the stock valuations to where a lot of analysts are saying we're in a bubble and that bubble's coming down. And that was like the first big move into AI. There may even be a little bit of a tech crash coming because that bubble is going to come undone, and there's going to be deleveraging the economy, or deflation in the economic output, not in prices, but in the economic output because of AI. So there was a boom into AI. AI itself is lowering the employment situation to where the Fed's now split and they don't know what's going on. They don't know what to ease or not to ease. But these tech companies are monetizing their assets now in AI. And so we're in a changing economy. It's kind of like going from the Industrial Revolution to the internet age. And now we're going from internet or tech age into the AI driven age. And so there's going to be these transition periods and this uncertainty about what's going on in the market. As I look at the economic data that is available, there's actually been a nice little manufacturing boost. And the reason is because manufacturing basically been turned off for a while. And now it's kind of ramping. It's not bringing us back to where we were, but it's a nice little bump. And so you have a bump in manufacturing, a come down in tech. And in addition to that, the dollar's rising. Well, how come the dollar's rising? Because the Japanese and European markets are weakening, partly because the US market strengthened a bit, the dollar strengthened, and so that's weakening the other economies. Their currencies are falling, and so therefore their economic output is worth less. And not only that, but Germany is in an existential crisis with relation to production right now. And Germany is really one of those big growth engines in Europe. So, and all in all, what I just said was deflationary economic output. AI is now replacing a lot of human. So people are spending less in the economy as that's happening. The tech companies are moving more to pure technology based and trying to monetize that. And world economies are really suffering right now because of deflation. And so you have sort of this currency battle going on. And it's one of those transition periods before we're going to have something big happen. And a lot of the analysts, again, are going back and saying gold's going to rise, which tells me they're expecting some continued worldwide deflation. We're just in a transition period, a lot of different stuff going on. But, if you're out there trying to get a job, it's a really tough labor market right now. And that's the main reason the Fed is thinking about easing. Now, if they ease long term, that's very bullish for gold. Short term could actually be a little bit bearish, but long term bullish for gold because of inflation and that type of thing, debt levels. Real quick, I'm sorry, I didn't mention this, but with Europe and Japan, in addition to currency challenges, they're in debt collapse. They're in the early stages of debt collapses right now, according to their analysts. Their mainstream analysts are saying we're in a debt collapse right now. The debt is just overwhelming everything. And in fact, if you look at corporate America, the debt is overwhelming. And that's why AI is replacing jobs. They took on so much debt that they had to deleverage. And the easiest way to deleverage is let go of people. And now that AI is starting to replace jobs, that's what's happening. In a nutshell, we're in a stage before the big crash of where the debt burdens around the world are really forcing the hand of companies and causing all sorts of issues with sovereigns and their currencies and things. And AI is a temporary boost. But when AI takes over, there's going to be less internal spending in the economy. So you're going to have all the sorts of trade imbalances and things. And it's what I predicted would happen in 2025, 26 is where you have this very volatile move in the markets as a lot of this gets worked out. And I think eventually it leads to a big crash because even though we have AI, it's not going to make up for the debt loads. It's just something they're putting into place really because of the fiscal problems. And it's going to be hard times, I think, for people around the world who don't have savings, specifically don't have gold and silver. Gold price can rise in either a deflationary or inflationary environment in terms of growth. And you have to separate out deflation and inflation from an economic output and a monetary. One is economic, one's fiscal. And so we're having inflation of prices, even though we have deflationary output. In fact, there's so much money in the world chasing fewer goods. That's one of the reasons prices are continuing to rise and GDP is not catching up. And this is the Austrian explanation for the business cycle. What von Mises and Hayek and Hazlitt and all of those guys said is coming true. We're now getting to the almost to the Minsky moment, the melt up moment, and then the crash. And we're getting closer and closer to that point. Hence the movement into AI, digital currencies, and things like that, because the powers that be want to absorb. The fiat currencies are going to die off, and they want the solution to be the CBDCs and stable coins and things so that they can completely control monetary flows. They think to prevent the business cycle. It's not going to prevent the business cycle, but the business cycle's got to crash before the introduction of those. And yes, gold price can go up in any case in deflationary, inflationary environment. If you go read a lot of Austrian economists' account of gold price during periods of economic inflation and deflation, gold can go up in either case. In fact, gold pretty much goes up all the time, excepting periods in which you have these economic booms in which people go to bubble assets like stocks, bonds, real estate. Those are always short term. They typically go in 4 to 10 year cycles, and then you have your 80-year cycles, and then you have your 250-year nation state cycles. So going back to cycles that we've talked about before in your program, you're having the culmination of this extended 15 to 16-year business cycle, which is longer than normal, the 80-year conjunctive wave cycle and the 10 or 50-year nation state cycle. But we're also looking at the collapse of 700 years of bond issuance dating back to the Middle Ages, the collapse of that bond market, and the first rise in overall worldwide bond rates, concerted rise in 700 years, or any sort of debt rate in 700 years. So this is a much bigger cycle as well when you're looking at it from a debt perspective. So it's the reset. It's basically the reset. This is going to be a sort of a violent stage and a working out of a transition into this more AI and technology driven economy. But debt's got to be cleared out. Jobs have got to be lost. Currencies have got to crash. And that we're kind of in the throes of that, not to the big piece of it, but we're getting there. And so when I look at it really long-term, it makes sense. Short-term, it's confusing. Long-term, if you look at what's going on, it makes more sense. But Austrian economics is a very important piece of understanding that. Keynesian economics, they taught us, and micro and macroeconomics in high school and college will not explain what's going on.
A significant shift is unfolding in global finance as rising interest rates strain the bond market and accelerate the breakdown of traditional debt structures. With bond values falling, bank balance sheets weakening, and depositors reacting to rapid losses, the system is showing the same early stress signals seen in previous failures. At the same time, digital frameworks are being positioned as the replacement for an aging fiat model, supported by bail-in mechanisms, taxation controls, and tiered CBDC structures. As sovereign debt burdens grow unmanageable, policymakers are increasingly preparing for a transition that phases out reliance on long-dated bonds entirely. Parallel to these developments, central banks are accumulating gold to rebuild balance sheet strength ahead of a structural reset. Their public comments now openly frame gold, not fiat currencies, not bonds, as the ultimate anchor for the next stage of monetary architecture. With global economies weakening and technology reshaping labor markets, the setup points toward a decisive change in how value is stored and managed. Let's get back to the interview.
Crash comes faster. So the crash in bonds comes when interest rates continually rise, because a couple of factors. People, if you're holding an existing bond, the face value is inverted from the rate. So as the rate goes up, your face value to recover that in the secondary market goes down. That's why banks fail, because they hold bonds as assets. And when interest rates rise and those bond values fail, they fall below certain thresholds, which if you looked at like Silvergate and some of those other banks that failed a couple of years ago, there was a run on the deposits of these banks because the rates were rising, causing bond valuations to fall, causing current and long-term account ratios to fall, causing bondholders of banks to panic and say the bank's going to go under, and they pulled their deposits. And of course, a couple of banks did. And then of course, the FDIC came in with their insurance scheme, and there were bailouts on, they didn't bail out the depositors, they bailed out the investors. So the depositors still lost their money. Investors, they took haircuts, but they weren't washed completely. And I will also say this, a feature of the digital system is coming as they want to get rid of bonds permanently. So because it's a limitation on the system, the digital system uses two pieces. It uses the bank bail-in and confiscatory laws in Dodd-Frank to adjust the money supply by taking money straight out of your bank account if they want, or devaluing it with a push a button on your bank account, as well as taxation. So the IRS will become more important because they're going to tax excess out of the economy, excess. And they also are a two-tier system in CBDCs where the international trade, what they call like the sovereign or the top layer CBDC, is a trade between the central banks of each region. But if they want to issue the common currency to the people, they can do that as many times as they want. So you could crash a currency, reset it, and it does not affect international trade flows. And so when you look at all those features, they're going to be less reliant on debt in general. The debt model is going to change. So when I say the 700-year bond market is going to collapse, it's the collapse of an asset class that's not going to come back the same way ever. And that is, by the way, by design. This fiat debt system that blew up in the mid 1800s, and then of course in 1913 with the Fed, is breaking, and they have the replacement in place, and it's going to be different. So we're changing over from that fiat bond currency system into something different. And so eventually they want all the bonds go. They don't care. They want to get rid of all. That's why they printed up until this point, because at the end of the day, they're just going to hang the consumers with it. And by the way, that's why the central banks have been buying so much gold to recapitalize their balance sheets, because what's going to happen to gold when all this goes off? Straight up. Why is Trump saying we're going to revalue the gold but hadn't done it yet? They're waiting on the value to go, and they're going to recapitalize, and it's going to help them address the issues, gold and Bitcoin, address the issues in the sovereign wealth fund with the debt, and allow hopefully some version of the dollar survive in an electronic format. That's something I've been worrying about for 5 or 6 years. It's a complete switch over of a system. And if you're looking at the future through the lens of the past, you're not going to understand or see it. And that's why a lot of people don't understand or see it. But if you read the white papers from IMF, the BIS, the central banks, and you listen to them speak in public, they're telling you what is happening. Very interesting that Christine Lagarde came out and said that these fiat currencies are weakening. That she thinks the dollar is going to weaken long term, and that gold is really, she says it's not Bitcoin, it's gold. They know, I'm telling you, the central bankers know it's gold, not the private currencies. And they're going to capitalize their digital systems with gold. Christine Lagarde gave the plan out. This was just a few days ago. She said it. It was, I don't remember what conference I was reading it on Zero Hedge. And they quoted her and had a video. And she's saying gold is the ultimate safe haven. It's not bonds. It's not the dollar. They know. She's a central banker. They know what's coming. They're going to recapitalize with these assets, and they're going to push us into digital currencies. And they're starting to talk about fiat currencies and debt as an issue, because they want to paint that as the problem to replace it with what? Solution. Problem, solution. Problem, fiat debt system. Solution, digital system. And the gold will be in the central banks backing it up. And they don't want privates to hold a lot of gold, with the exception of China. China and India want their citizens to hold gold. The Western world does not. The technocrats do not want you to have a lot of gold. We've been having this argument on social media very recently, well, not an argument, a healthy debate, I would say, amongst a lot of gold and silver market followers that have been talking about how much gold China has. And I wrote an article for JM Bullion back when I was writing for them 2 years ago. And I supposed, based on trade statistics, mining statistics, shipping manifest, that kind of stuff, about how much gold China had. And they, for the last 30 years, have kept almost all of it internal. And I think at least 25,000 tons. Some people are saying 30, 40, 50,000 tons. It's just not on the central bank balance sheet. It's in the sovereign wealth fund. It's held by the people. And if China wants to get gold from the people, they can get gold from the people. You know, there's ways to do that. They can make it incentivize to get the gold from the people by using currency. And if they're using a currency which ultimately has less value, it's a great trade for them. You know, Russia's doing the same thing, the oil for gold trade. How did Russia stabilize a currency after the sanctions? They pumped out a bunch of oil to China and others, and they traded it in gold. And what that did was that put a floor under the price of their currency and a floor under the price of oil, and it brought a lot of gold in. Russia's recapitalized their sovereign balance sheet using oil to get around the sanctions to use what? Gold. And so they know that gold will be the center, and they know they're going to the digital system, but the fiat and debt system is going to collapse, and they know it, and they're going to make it the enemy. They're going to make it the cause. They're going to demonize it to get us in the digital system. That's the solution. Everybody's going to demonize the dollar. It actually helps them in the long run. It seems counterintuitive, but if everybody demonizes the dollar as the problem, then what is the solution? Oh, we've all come out with this electronic system. And they actually want people to use Bitcoin now because they can use it to pay off debt. That's why Bitcoin's in the sovereign wealth fund. And the scheme that they wanted to do was they were going to recapitalize gold, buy Bitcoin, use Bitcoin to pay off a lot of the treasury debt. And they said it in black and white. And then was it Judy Shelton that came out and said, we need to issue treasuries in gold, but we don't want that because the treasuries blow up. It sucks gold, into the U.S. government, and it extinguishes the treasuries, which would seem like a good thing, but we want the people to own the gold. So you see the playbook is there. It's obvious. You have to understand you have to understand Austrian economics. One of the things I'm doing is bring on Austrian economists into my program. I just had one on a couple of weeks ago. I'm working with the Mises Institute to bring more because we need to go back to economics. It's hard to understand gold, digital currency, debt flows, currencies, all this crap if you don't understand a proper accounting of economics. It's not a science. It is human action, it's human behavior. Mises and Hayek had it right. And if you look at the world through the lens of Austrian economics, it makes more sense. But if you don't have a solid basis, if you haven't read the books, if you haven't taught yourself, you will not understand it.
Growing instability across global debt markets is accelerating the shift toward tangible assets, with mounting fiscal strain and rising structural costs pushing policymakers toward a full system transition. As traditional bonds lose reliability, central planners are preparing new digital mechanisms while simultaneously reinforcing their balance sheets with tangible reserves. The expanding use of AI, the loss of industrial competitiveness in significant economies, and pressure from sovereign debt loads are converging into a period in which liquidity, confidence, and monetary policy become increasingly volatile. This landscape favors assets that hold purchasing power during major resets, especially as policymakers openly acknowledge long-term currency weakness and the need for stronger anchors within the following monetary framework. These combined forces create a backdrop where gold and silver stand to benefit from both policy shifts and structural repricing. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.